to have Jamie and Tom walk us through the ins and outs of VC debt financing and how that can be a good lever to use when you're going through your fundraising rounds. And so first, I want to, read some quick bios about Jamie and Tom before passing it over to them, just so you have context around who they are and the value that they can provide to the conversation today. So first, I want to introduce Jamie. She is a Vice President of Credit Solutions in the Technology Banking Division at SVB. Her role involves lending to technology companies in the Midwest, ranging in size from pre-revenue companies to large corporations, and across segments such as enterprise software, consumer, and fintech. Jamie's worked at SVB for 5 years in Chicago and Boston. She graduated with a bachelor's degree from Washington University in St. Louis, where she studied biology and creative writing. She grew up in the East Coast in Rhode Island and lives in Chicago now, where she enjoys cooking, tennis, and trying new restaurants in her spare time. So Jamie, we're excited to have you here today. And then also want to highlight her colleague, Tom, who is a first year of tenure at Silicon Valley Bank, where he works in their technology and innovation banking division. His role involves working with founders and executives from pre-seed to $100 million revenue tech companies. And prior to SVB, Tom was a private banker at JP Morgan for 6 years, working with private business owners and public company executives. He's also the co-chair of the Midwest Committee of Hope for the philanthropic organization Help for Change. And as a first-generation citizen of the US, Tom's a proud graduate of the University of Chicago, where he studied economics and psychology. On campus, he participated in varsity football, Greek life, and acted as the president and treasurer of the UChicago sports business team. He spent his entire life in the Chicagoland area, having grown up in the northwest suburbs of Chicago, and in his spare time enjoys being physically active, watching sports, traveling, dining out, and attending concerts. And his favorite sports teams are obviously the Cubs, Bulls, and Bears. So just some fun facts there for you all to get to know our presenters today. Very excited for the opportunity for them to walk you all through VC debt financing, what that means, and how it can be of benefit to you. So without further ado, I will pass it over to Jamie and Tom.
Beautiful. Thanks, Kendall. Appreciate it. And thanks everybody for joining us today. We'll have kind of a Q&A at the end of this session where you can ask any questions that you have coming up. So if anything that we mention spurs a question, feel free to write it down or put it in the chat, and we will be sure to answer that at the end here. Yeah, again, I really appreciate everybody joining us, and we'll kind of walk through venture debt and what it can mean for startups. But as a starting point and an exciting time, I kind of want to talk through just real briefly on kind of the Midwest for VC and what it's looked like this year. If you've been paying attention to the news at all, it's been a record year for funding across the Midwest, and you can see a bunch of different statistics here. VC investment in the Midwest has probably exceeded any other year that it has occurred. And the growth rate is exceeding the national rate from an investment standpoint. So super exciting times to be in the Midwest, especially with pre-money valuations more than double what they were in 2020. And we're seeing more common instances of mega rounds than there were last year. So pretty exciting and very much so a boon to the industry that we find ourselves in, which is kind of debt financing to complement that VC raise amount. And then on the next,
I don't mean to interrupt, but SVB has given this talk before. I'm Amy Ripka, CEO of Lucy Therapeutics. And what I find really disturbing about this is that this was one of the worst years for funding for women. So while it has been a record year for VC, private equity, and probably venture debt, it has been one of the worst years for women. So I find this slide just a little unfair as far as the demographic you're speaking to here.
Yeah,
certainly noted. Yeah, I mean, plenty of work to be done in terms of gender equity on that side, and hoping to correct that over time and get it to a place that's certainly much more equitable than it is now, but duly noted on your comments there.
And also, if I can just jump in really quickly, like Amy, definitely hear that. And that's part of the reason why we wanted to bring them in for this session, to one, provide more knowledge and expertise around the different avenues you have to raise and be successful. And so I think the more, RAs and SVB are able to partner in spaces like this, the better, or the bigger impact we'll be able to have in the industry. And so that's the exact reason why organizations like RAs exist. So we're very happy that you're here, that you're calling it out, because it takes people like you to, keep pushing the boundaries. And while, yes, this slide, doesn't necessarily represent women and the success that women have had this year, I think it's helpful just to have that context and to know where the industry is headed overall, and then how we can continue to kind of fight forward to make sure it's equitable for everyone. So great call out. And as Tom said, a lot of work to be done. And our hope with this is to provide that space.
Yep. Thanks, Kendall. And then on the next slide here, we've got, funding by state within the Midwest, which shows pretty heavy lean into Illinois. And that's probably in part due to Chicago's success this year from a fundraising standpoint. So especially being a Chicago native and being based here in the Midwest and in Chicago, really exciting to see the fundings going on across the Midwest, and especially in my hometown here. And then lastly, just on valuations, as I previously mentioned here, valuation continue to creep up, and the jump from 2020 to 2021 has been pretty staggering in terms of what companies have been able to fetch from a seed, Series A, and even Series B standpoint. So continued, hopefully, good tailwinds for the VC community and the tech community at large. And on the heels of all this equity financing, really excited to talk more about the venture debt space and how that plays a role within the VC community and within tech ecosystem at large. So kind of as a first starting point here, venture debt is kind of the new age way of lending to companies, which is in contrast to the old school commercial banking lending model, which you can see here is really heavily asset based. That's based on physical assets, and normally looking at companies that have consistent positive cash flow and are profitable. And in a lot of cases, these lending deals involve some form of personal guarantee, and there was downside risk in the form of kind of tying up balance sheet capital to create this debt deal and put it in place. Whereas where SVB has kind of carved out its niche is in this newer model that's catered more towards, not necessarily lending against physical assets or any type of collateral in that sense, but more so looking at the investment syndicate that came together to invest in the company and using that as the basis for lending. And it's very much so tailored to kind of the early stage tech space, which tends to be, cash flow negative companies most often, with the focus on growing that top line over time here with the hopes that the company can potentially become profitable over time. And as opposed to kind of the old school commercial lending model, there are no personal guarantees with this type of debt. And repayment usually comes in the form of future equity raises that occur for a company's life cycle. So pretty stark contrast from what was historically a very industrial heavy form of lending to now in this new age technology-based companies that we find ourselves in, a very much more venture-friendly model and startup-friendly model for lending. And there's a couple different reasons that a company could use debt. Most often it's the case that venture debt is provided as a means of runway extension ahead of a future capital raise, in which case this acts as somewhat of a dilution optimization tool for companies to be able to extend runway, usually, 1 to 2 quarters before, Series B, Series C raise, so that company is therefore able to hit higher metrics than they would otherwise, and hopefully fetch a higher valuation as a result. And then in other cases, things are going a lot better than planned, and the company has found product market fit to a point where growth has been explosive and a company needs to hire into that growth. And so this debt can be used as a means of adding fuel to that fire and accelerating that company's growth. But it's all centered around the idea of creating leverage for a company when it's doing really well, and then in other cases acts as somewhat of a business insurance tool in the event that things are kind of going awry and need a couple quarters to shake things out. So that's kind of high level what venture debt is and use cases for it. And now I'm going to turn it over to Jamie to kind of give us a deep dive in different parts of venture debt and other forms of credit.
Awesome. Thanks so much, Tom. And thank you everyone for joining. We're really excited to talk through this and do a deeper dive on what venture debt actually looks like. I think sometimes if anyone is on the call has been through that process, you'll kind of get a term sheet, and it's kind of like looking into a black hole to figure out how to compare it, what all the terms mean. So I think what we wanted to do is really drill down into it today and kind of talk through, what these loans typically look like and the common use cases for them. So I'll start talking through term loans. This is kind of your basic venture debt. Essentially what it is some amount of capital that is available to you. And we'll talk through kind of the factors that SVB and other lenders would look at to determine the amount and structure of venture debt. But at a high level, really what it looks like is you'll have some draw period, I would say typically 6 to 18 months, where you'll have the capital available to draw down. And I think one thing to note is, we always say that the best time to get debt is when you don't need it. So if you're freshly capitalized, just raised money, or have a pretty strong balance sheet, that's really the time that you're going to get the best bank deal. So while it may not seem intuitive, since you aren't going to draw it down at that time, it makes sense to get it in place as that insurance policy, since you'll get the best terms. And you'll still, with most venture debt facilities, have that draw period where you would be able to, get it in place, and then in a year and a half, actually use it if you need it. So after that draw period, during that time, it's interest only, so you wouldn't pay any payments on the debt. And then from there would be the amortization period, typically 30 to 42 months, where you would pay back the debt in equal payments. And I would say, most of the time, the way that we see this happen is a company will get a venture debt facility in place, after the Series A, and in 12, 18, 24 months, it'll be time for the Series B already. And we would try to refinance the debt, kind of grow it alongside the business as you continue to scale. That's kind of the thought process behind how this debt can really scale over time. So really what this capital is used for is pretty much any operating expenses. So whether it's to accelerate hiring, marketing, research and development, even financing equipment, if your business has equipment. This capital is really flexible, and a key note is that there's typically no financial covenants tied to it. So it's really capital that you can use at your discretion, and you won't be held to any specific metrics by the bank that you have to hit. Kind of touched on the repayment already. In terms of security, like Tom mentioned, there are no personal guarantees here. So that's obviously great for founders to not have to be, personally involved in that. banks will typically take a first priority lien on all the assets, but a negative pledge on IP, so not including intellectual property in the lien. In terms of pricing, this, it really depends. There's a few fees listed here that you could see. And it's really kind of an iterative process that SVB likes to run, whereas like if you just kind of want to pay for the debt up front and have it and not have to worry about it later, that's totally an option, but we can also backload some of the fees to save for when the business is more scaled and potentially has more capital to pay down these fees. So we really target kind of an all-in return in the mid single digits, which you'll see here is kind of the interest rate. And then the one key term that might not be familiar is warrants that we take. So for really any non-covenanted venture debt deal, there would be stock warrants tied to it. And what that typically looks like is around 15 to 40 basis points of fully diluted ownership that SVB or the bank would take to be able to exercise at an exit. And this is really kind of, when you think about portfolio theory for banks, it's kind of, this is how those warrant hits that we get kind of outweigh all of the losses. And getting these warrants also keeps us aligned with, the board, investors, as well as the company, because we have stake in the game. Kind of looking at the value of term loans specifically. So really you have your equity cash or cash on hand, adding in this minimally diluted bank debt. Again, I said, 15 to 40 basis points. So pretty small amounts that we're talking compared to equity investors. Adding in that cash really allows you to push out runway. Maybe it's a few months, maybe it's more, and continue to build enterprise value. So it's a useful tool to have in the earlier stages of your business. So when you're looking at term loans specifically, there's a few things to consider. Touched on a few of these already, but size, I think, is important. You definitely want to get enough capital so that it suits your needs and is meaningful to pay for. But, you also want to be careful with leverage. Never know what's going to happen. COVID 2.0, taking on leverage is obviously something to be mindful of and a discussion to have with your board. In terms of availability, you may see sometimes that portions of the debt would be tied to potentially revenue milestones or something like that, where, the bank just wants to see continued scale and potentially unlock more capital based on that. So when looking at kind of the terms, you want to make sure that that aligns with how you're thinking about the business and your plans going forward. And then again, just kind of running through all of the repayment terms, covenants, and costs to make sure that they are in line with market. And we'll kind of touch on later, the best way to run a debt process, but always important to get multiple providers' opinions and make sure that you're not like getting a market deal, but also comfortable with the people and bank that you're working with. So that's kind of the overview of term loans. The second most common type of venture debt that we do are lines of credit. So there's different types of lines of credit. Pretty much all of them would be revolving lines where you can borrow up and down on them during the tenor as you please. So there's a couple of different borrowing formulas that we use. First being recurring revenue, kind of a buzzy debt facility, I guess you could say, where we would look at some multiple of your monthly recurring revenue if you're a SaaS business or have some sort of subscription revenue. Essentially lend on a multiple of that to use as really backup liquidity would be the use case for a recurring revenue line or runway extension. In terms of accounts receivable lending or inventory lending, those are a little more traditional. But again, just ways to manage working capital, kind of smooth out those payments for payables and manufacturing, or really just to get a cash bump from your AR earlier than you would collect it. So we can kind of, and depending on the business, in the next slide, look at different formulas and kind of see what makes the most sense for your business. In terms of what these actually look like, the maturity is usually 1 to 3 years. Principal would be due at maturity and really would just be interest only throughout the whole facility. And lines of credit are a little bit more of a permanent source of capital, where we would kind of look to continue to renew the line as long as things continue to go well, and potentially increase the size over time. Similar to the venture debt term loan, kind of a bunch of different fees that could come into play. Really just depends on where the business is at. But again, targeting a similar all-in return in the mid single digits, similar warrants as well. And I would say that with lines of credit, it's definitely more typical to have financial covenants. So that could be a liquidity covenant, something based on revenue, bottom line operations, really anything, and those main KPIs that we want to track the business to. So with financial covenants, you'll usually see with that additional structure that makes it less risky for the bank, lower pricing. So that's kind of a trade-off. If you know the business is at a really good place where you're feeling very confident and comfortable in those financial metrics, like it's definitely worth leveraging to be able to pay a lower cost. Whereas we can also do lines of credit that have warrants tied to them. So that is like, if you have warrants, you probably will not have covenants. So it's kind of a trade-off. It really just depends what makes sense for you. So I've sort of touched on these. You know, for receivables-based lending, this could really be any company type that has a significant AR base, and being able to access the line just really helps to alleviate that cash crunch where you're waiting to be paid for those receivables. In terms of inventory, this one's actually interesting for a lot of our direct-to-consumer businesses or hardware businesses, where you can kind of leverage the inventory that you have on hand to be able to use the line and, you know, get repaid on a shorter timeline than you otherwise would have. And in terms of recurring revenue, this is, like I said, really leveraging that subscription revenue as backup liquidity, but can also be used, of course, to fund that customer acquisition and continued OpEx on an ongoing basis. And those are typically for SaaS businesses. We do a lot of enterprise SaaS recurring revenue lines, and that's pretty common. So when you're looking at lines of credit, it's definitely most important to kind of look at that borrowing formula. So for recurring revenue, bunch of different providers may look at it different ways based on either annualized recurring revenue, ARR, or monthly recurring revenue, MRR, and some multiple of that. So could be anywhere from 3 to 6+ times monthly recurring revenue. Again, depends on the stage of the business, but it's worth to kind of compare between providers and see, because that's going to be your availability. Same goes for really receivables. For example, if you were to have a business with significant foreign operations, there may be some banks that are less comfortable including foreign receivables in the borrowing base, and that could definitely impact things. So just being mindful of, you know, these important terms that could definitely change how much you actually would have available to borrow. For financial covenants here, it's always worthwhile to kind of model the proposed financial covenants into your model to make sure that you feel comfortable with the amount of cushion that's being provided, and make sure that it's, you know, something that you feel that you can meet, because, you know, getting into a situation where you trip the financial covenant would potentially look at some sort of restructure on the debt. So, and again, in terms of costs, you know, making sure it's market. Today's market is crazy, and you definitely will see a lot of different things. So worthwhile to get a few different opinions. And in terms of strategy, you know, between weighing a line of credit or a term loan, you know, I think that there might be some businesses that think they want a line of credit when really what makes the most sense is a more flexible term loan that, you know, kind of has less tied to it. So really thinking that through and which solution would be best. And that's something definitely to brainstorm with your board about. So I kind of touched on venture debt and lines of credit, but you'll see here kind of throughout the life stages of a business, there's more that we can do, and more debt solutions that, you know, alongside equity or other ways to fund the business are really valuable. So once you sort of get to that Series C, D, and beyond, there's some of these other options, including mezzanine debt, which is, you know, bigger quantums of debt that's junior instead of a senior lien. So more equity-like in nature, but obviously at a higher price point. And these mezzanine debt and syndicated loans are the types of facilities that, you know, could be that last capital in before an IPO or exit that's less dilutive than equity. So it could be very useful for the business, as well as convertible debt. That's more of a post-IPO potential product. But as you can see, we really run the gamut on what we can do. And I think it was part of Tom's intro, like we have facilities that are 100 million plus. So there's really, really great potential there. And just to kind of orient this a little bit, I talked a little bit about senior and junior debt. So the senior debt solutions, those are the venture debt, term loans, the lines of credit. Those are kind of get the first priority lien. So any senior debt would be paid out first in a downside or liquidation scenario. But those are the most low dilution. So smallest amount of warrants, smallest equity stake. But what we typically look for is primary equity investors to be involved in the business. For junior debt, again, still less dilution than equity, but slightly higher than senior debt. Kind of comes second priority to that senior debt, and would be subordinated to it as well. And then equity, of course, is not going to be repaid, but because of that is more highly dilutive and no preceding requirements. So that's kind of the overview of very, very quick overview of venture debt. Obviously more to be said, but I will turn it back to Tom to kind of talk through what it's like to run a debt process for your startup.
Yeah, thanks, Jamie. Now that everybody here is a debt expert, is a good time to kind of consider, based on where you're at from a runway perspective and based on what your goals are, really checking in with your board and understanding, is debt the right solution? If so, what type of solution might make sense? And kind of glean from other members of your board if they've had prior experience at other startups potentially within your sector, in using debt as part of the balance sheet? And if so, in what ways was that accomplished? And then once you have a firm understanding of what it is you're looking for and kind of the dollar amounts, what it would be used for, all that good stuff, is then where you would go out and talk to the SVBs of the world and try to gauge from them what might be possible from a lending standpoint. And then after some negotiation and some back and forth on terms and ironing out what might be possible, and then ending up with a debt term sheet in your hands, going back to your other references and cross-checking those to make sure that what you're seeing is in line with what others have been proposing, for one, and also just making sure that you're getting the absolute best deal that you can, given the environment and the context of your business. And so that's kind of what the process looks like at large. Obviously, every situation is unique, but VCs in terms of venture debt have had different reactions. I'd say on the whole, most tend to enjoy it and think it's a good part of and a smart way to go about adding to your balance sheet for the reasons listed here, which the first and foremost being it acts as kind of an insurance play against downside cases for a quarter or two while a company is figuring out a situation that isn't going as smoothly as one would hope, and thereby not having to take a down round or not having to take bridge financing as a result. And then in the same vein, with an additional extra few million in debt, as opposed to pulling on that via bridge equity, you're able to maintain board dynamics that may have shifted if you had to take subsequent equity financing ahead of a full equity raise. And then, of course, there's those within the VC community that don't necessarily like it for the reasons that if they have invested in a company and they really feel strongly about a company and everything is going well, then this can act as kind of, this could stand in the way of them providing more equity financing and therefore getting higher ownership. So there's kind of got to understand what's at stake for VCs for debt. And then the other big piece is occasionally, when we're putting together debt deals or when debt deals are being negotiated on, that some portion of the debt could be tied to a milestone, whether that's revenue or some other indicator of business success that VCs may find that companies may tend to focus on that as part of their business plan as opposed to being more strategic. So that's just some other considerations. But I'd say on the whole, most VCs are for debt and think that a prudent amount of leverage, if possible, can go a long way for a company, especially at its early days like this. And then this slide just kind of goes over different types of providers and what they're capable and kind of the lanes that they swim in. So you've got kind of the full slate commercial banks on the left, and then in the middle you've got non-bank debt lenders that usually come in more strenuous situations or kind of non-traditional situations that with those accompany occasionally higher costs. And then on the far right are some very niche type of lending based on asset-based lending or other types of early stage financing outside of equity. But the big question that you should ask of your provider and you should make sure by cross-checking with other references is what type of lender you're working with in terms of, are they patient when things aren't going necessarily as great as everyone would have hoped? And are they willing to work with you in a situation that may not be all peaches and cream? And we've come into situations where we're probably close on a lot of terms, but SVB has continued to be, and now for almost 40 years, has been known to be in the business as a very patient lender with respect to kind of this venture debt financing, which can run amok occasionally. But again, really, really good question to ask the people that you work with and the people that you are considering evaluating for debt. And I'll kick it back to Jamie real quick for kind of what the process looks like, 101.
Yep. Thanks, Tom. So in terms of SVB's lending process, specifically what it looks like, kind of start out with an intro meeting, figure out what the ask is for debt, kind of what the use case is, here, brief overview of where the business is at, and just kind of understand what you're looking for. After that, we would really just dig into diligence. You'll see here kind of a list of what we would typically want to see, most important being, you know, those forward-looking projections. We're obviously taking a bet on the future of the business and kind of want to see what you are trying to do, as well as really just getting to talk with the management team, understand the near-term initiatives, kind of, you know, what you're trying to accomplish in the next 12 to 36 months. And that's kind of where the debt could be helpful. So really want to understand that. I think our hope is that the diligence is lighter than your typical VC or investor diligence. We've heard it's an easier process, so that's a good thing. One thing that might be part of the diligence process, either on the front end, and SVB specifically really likes to do all of our diligence on the front end, so there's really no kind of risk of the deal getting done once we're fully signed up. So that another thing that could come up would be investor calls. We have really great relationships with VC and PE investors at SVB. We also bank funds as well. So really tied into that ecosystem, and it can be really helpful for us to just get investors' perspective on the business as well, aside from just hearing what's going on from the management team. Kind of after that diligence review, probably would take around a week. We would propose terms. From there, kind of refine them, make sure everybody is in agreement, and then get the loan in place. And I would say that typically takes probably 30 to 60 days, depending if it's, you know, a more complicated facility. But kind of after that point, you would have the debt available to draw at your leisure. And sort of what we're really looking for when looking through the diligence materials is probably primarily kind of business traction. You know, how is the business performing since inception? Like, what areas are they having success? Where are they kind of still working out the kinks? What vertical are they playing in? Is it a competitive market? Are they able to kind of expand to different verticals? In terms of technology, you know, is it a really differentiated technology? Is there a lot of IP in the business? That's, you know, the underlying business itself is obviously the most important. We're also looking at the quality of the management team. You know, it's great to see management teams that have worked together before, potentially, maybe somewhere else, or just really passionate founders who, you know, have success and believe in their product. We'll also very much be looking at the equity raised, of course. So kind of total equity raised in the most recent round potentially, but also in total, to kind of see how far you've gotten on that money. And then valuation as well will play into what we can do. And then in terms of investors, kind of, we really look at who the investors are on the table are, how much capital do they have to continue to invest, as well as, if the investors make sense for the business. For example, if you're a fintech company, like it's really great to see, really strong fintech investors around the table for us. Just gives us continued comfort in the business and kind of where you're headed. I'll get back to Tom to kind of give you our last little pitch on SVB before our Q&A.
Yeah. Thanks, Jamie. Yeah. In case you guys aren't familiar with Silicon Valley Bank, or if this is one of the first few times you guys are hearing about it, just wanted to give you a quick overview of the types of companies we work with. So we, in addition to being a commercial bank, we've also got an investment banking arm, a corporate banking arm, and a private banking and wealth management arm. So kind of a full slate of services for founders and their companies, located all over the world. I think we've got something like 25 or 30 offices across the US, and then another handful nationally or internationally, that is. And we specialize in the tech and innovations economy at large, but have specific focuses, as you can see there, in hardware, software, life sciences and healthcare, fintech, energy resources, and then our other two client segments, in addition to working with startups, are private equity and venture capital firms themselves, and also working with premium wineries out on the West Coast. And then a little bit more about the technology practice itself. We work with roughly 50% of all Series A backed startups across the US. And I think right around 3/4 of all VC-backed tech companies went public in 2020 were SVB clients. So pretty great from a coverage standpoint. And then on the next page, similar statistics from the life sciences and healthcare division. Work with a lot of healthcare focused companies and innovative on the life sciences front, and have seen them grow from start to finish. So that's kind of venture debt and SVB in a nutshell. Everybody, appreciate everybody's times, and at this time we'll open it up for questions here.
Yeah, thanks so much, everyone.
So if you have a question, you can go ahead and raise your hand. And I saw there were, a couple of questions in the chat. If we aren't able to get to that, we'll shoot them over to Jamie and Tom after this, so we can just gather their responses. But to go ahead and raise your hand if you want to come off of mute and ask your question, and we can go from there. Sally Ann, go ahead.
Okay, thanks, guys. Hey, I was going to ask you a question with regards to what are you seeing as your Series A round amounts? Is there sort of a certain number that you're more comfortable with than not?
Yeah, I mean, I think Series A amounts we've really been seeing continuing to increase. And I think kind of a few years ago, what was a Series A round is now a seed round. Like, we're seeing 10 million plus seed rounds, which I think would never have happened a few years ago. So in terms of Series A, I would say we could see anything from, below 5 million to somewhere in the $15 to $25 million range.
Yeah, I've actually had a great relationship with you guys in the past, and I've actually used every part of your different financing types when we originally started TiVo.
Oh, awesome.
Yeah, so proof in the pudding here, and I really like what you guys do. But I remember when we came with you guys, when we started, we did a Series A, it was at 3 million. Nowadays, that's just not where things are at. And the company I'm with right now, which is a startup, is doing a seed round. Only because when we talk to people about Series A, they're like, oh, that's not a Series A, that's a seed because it's less than $30 million. And I'm like, oh, man.
Oh, wow.
Yeah,
that's crazy. Yeah, I mean, we're in, kind of in our slide decks, a lot of it talks about, starting at the Series A, but with these bigger seed rounds, I mean, it's obviously changing how we're looking at debt as well. Since
Okay. Well, someone can follow up with me because we're doing around for about 6.2 million.
Absolutely.
Okay.
Thanks
Thanks.
for joining.
Rashida, do you want to go next?
Sure. Hi, can everyone hear me?
Yes.
Yes, hi. My question, I'm just going to elaborate on a question I put in the chat. One of the slides you mentioned, valuation for founders takes into account their investor profile. As you know, there are a lot of emergent funds. I'm going to be emergent fund manager soon that are solving some of the diversity issues. So Black-led funds, Latinx, LGBTQ+, women, et cetera. Is there a disadvantage for founders trying to do debt financing through SVB by having these funds that are newer, thus don't have as much of a track record? And how is SVB kind of accounting for that in their equation of investability?
Yeah. No, I mean, that's a really good question. And I did talk about how SVB has a lot of relationships with funds, but we're also very much focused on bringing new funds on board and growing our relationships with new funds, particularly in the D&I space. Like, that's a huge focus for us. And, it's, for us, it's probably a little less about the track record of the fund and more just, the fit with the fund and the company, and making sure that, they have those synergies and really strong relationship between whoever's the board member and the management team. So we're definitely, open and wanting to build relationships with new funds. And I wouldn't say that we would hold that against a founder looking for venture debt.
Okay. Thank you.
Thanks.
If you guys had asked questions in the chat, it may be worth just repopping in and asking it live here, because I think we had a bunch rolling through that we may have missed while we were chatting.
Do you want to go with Christine next?
Great, thank you. Just curious, in your portfolio of companies, what do you see as the percentage taking the line of credit versus the term loan?
Good question. I would say at the earlier stages, Series B and earlier, typically we will see probably, I would say the vast majority of the time, we're doing the venture debt term loans just because it's, really flexible. It's not too expensive compared to equity. And it kind of makes things easy. It's basically just, increases the size of your equity round or current cash. So that's what we see the most of the time. The lines of credit, we usually will see kind of a combination of a term loan and a line of credit down the line. We would see lines of credit come into play a little bit earlier if there's, a really significant accounts receivable need or something like that, or inventory need where it's, very evident in the business that you aren't going to be able to get by without that working capital line. That's when we would see those come into play earlier. But otherwise, I'd say, the recurring revenue lines and other more, there's other structures as well. Those would come into play in the later stages.
Thank you.
Do you want me to go back through some of the chat questions, Jamie?
Someone just raised their hand.
Sure.
Oh,
Yeah, someone else.
hello.
We go to
Aisha.
Aisha.
There you are. Welcome back.
Hi, my name is Aisha. I have a question. So many people say that they want to invest in people of color or women, but when you get in front of them, it seems like they're just doing it for a feel good for themselves, but they don't actually want to invest in people of color or women of color. And how do we, I mean, even women, so how do we get past that and find people that are real about that? Well, how do you ask somebody like, are you for real, or is this just so you can have a story to go tell your friends later?
Yeah, I think it's a very valid question, and I'll give you what I think. Really, and we kind of touched on this in the presentation, like bank debt specifically can be a pretty transactional process if you want it to be. And we certainly experience that sometimes where, you know, some people are just kind of like, let's just get this in place. But I think it's important to build relationships with whoever you're working with. And that includes people that potentially would be funding you. So yeah, I think it's hard to cut past that and really figure it out. But at the end of the day, I think what we're really trying to do is build relationships with founders and our clients, and, you know, have that really strong relationship. That's the foundation for what we can do in the future. And I think that it's certainly tough. I don't know, Tom, if you have anything else you want to add, or Kendall.
Yeah, no, I think it's a great question, and I appreciate that. Something at least the All Raise team thinks a lot about, especially like looking at our Black, Latinx, Indigenous women and how we can support them, whether they're emerging managers or founders. And so one thing that we've seen, which is why I really value your question, is that in some of the research we've been doing, that overlapping networks, that's like the key differentiator between those that are able to get funding or get the debt from the bank versus those who aren't. And so as you think about, you know, being a woman and a woman of color, like it just exasperates, you know, the likelihood that you're going to be able to get that. And so what kind of a plug for All Raise, the direction that we're headed is more towards the building overlapping networks, so that when it does come time for you to raise money and you need to connect with investors, you don't just want to be transactional, but you want to have like real relationships with people who can help you, you can find that at All Raise through our future programming. And so the industry is not great at that. Actually, it's pretty terrible at that right now. So I think the thing, as the program lead for everything now, that's one of my biggest focuses, and especially designing programs that support those that are most disadvantaged, which are Black, Latinx, Indigenous people. And so it's top of mind for All Raise and our partners. Like SVB is a partner to us, and so they have, you know, put financial dollars and are showing up to events like this. So I think everyone is trying to do better, but sometimes you don't know what you don't know, and it's all about holding people accountable. And so questions like that, again, are super helpful to hear and just to bring to the forefront.
Thank you.
We're coming up onto the top of the hour. I don't know if we want to do one more, but we're right about at the top of the hour. Kendall.
Yeah, I don't see any other hands, so we can wrap up. Wendy, I know you have a QR code slide to share.
I do. I would love to ask everybody on the call, if you have your iPhone handy, take a picture of this QR code and snap it, give us some feedback. We really value your input on how we're doing with these programs, how these programs help you, and what we can do in future programs to just make them even better. And the only way that we can do that is to hear your feedback. So make your voice heard, take our survey, give us some feedback, just let us have it. We definitely want to hear it, all the good, all the bad, and all the in-between. So with that, I will go ahead and just say thank you again for joining us, and thank you to Jamie and Tom for sharing a little bit more information and around venture debt financing, which I learned a lot today. Really appreciate your time. We look forward to seeing you all at a future All Raise event. SVB, we really appreciate your partnership and your commitment to making the world a better place, and really continuing to support All Raise and our mission. So we will report, or we will record, or we have been recording today's session. So we will provide the recording link to you all. If not tomorrow, then the day after, just to give us a little bit of time to get it all edited for you. But thank you so much. Happy holiday season, tying it back to our icebreaker for today. And thanks again for joining. Have a wonderful rest of your day. Talk to you soon.